If you're watching this video, it means we've likely already discussed the all-in-one loan, or you just found out about this loan program and you want to see if it makes sense for your personal situation. Either way, the best way for us to do that is use this cool loan comparison simulator. Now, before we begin, I do want to acknowledge one thing. The all-in-one loan may not make sense for everyone right now, but it doesn't mean everyone shouldn't absolutely know about it. I believe the all-in-one loan is the most innovative mortgage in the market today, and I can say that confidently because I have two of them. I absolutely love this program and really excited to share more about it. Now, in this video, I'm going to focus specifically on a rate and term refinance. It is eligible for a purchase, rate and term, and cash out, but in this video, we're going to focus specifically on a rate and term. Now let's get started. Very first thing we need to do is go to our website, which is valorhl.com/AIO. That's Valor, VALOR, HL for home loans.com/AIO. All right, let's go scroll down here and get started by selecting this. We're going to go with start a new simulation. Now, had I already previously run a simulation for you and provided you with a code, you could select this option, enter that code, pull up the simulation I run. Or if you've already created a profile, you could log in here and see any previous simulations you've already run. Let's go with start a new simulation. All right, loan purpose. We said this is going to be a rate and term refinance. Now, as you're going to see, the majority of the information in here is pretty intuitive. There's only a couple fields where we got to get very specific to make sure we get accurate results. I'm going to cover it pretty quickly. I'm not going to go into how the all-in-one works specifically. I'm just going to show you how to enter the information in here and to get accurate results to see if the all-in-one makes sense compared to your existing mortgage. And then we can talk about specific benefits of the all-in-one and how it actually functions on a day-to-day basis. So home occupancy, the all-in-one loan is eligible for a primary residence, second home, and investment property. In this example, we're going to say primary residence. Comparison type, if you're doing a purchase or you're doing comparing, you were dead set on refinancing and you were looking at an all-in-one loan versus a new all-in-one loan, you select this option. Since we're looking at refinancing your existing mortgage into an all-in-one loan, and if that makes sense, we're going to select existing traditional loan. Now, we're going to get very specific here. We're going to say 2 years ago, you purchased a house for $1 million. And at the time, you put 20% down, so your balance to start was $800,000. In 2 years, we're going to say it is now worth $1.2 million, and your loan balance, and we're going to get real specific here, is now $775, $790, and 29 cents. What you would do is pull up your mortgage statement and you would see what your current principal balance is and enter that information. Now, at the time when you did this 2 years ago, you went with a 30-year fix. You have other options you can choose from. We're going to say you went with a 30-year fix at a rate of 5%. Now, age in months, that is how old is your current mortgage. So we said 2 years, so that's 24 months. And now that's going to bring up a principal and interest payment of $42.94.57. It's really important that you look in your mortgage statement and make sure your principal and interest payment matches that. If it doesn't, you need to go back and just check your loan balance. Now, if you want to refinance the all-in-one loan into pay off a first and a second with an all-in-one loan, you could do that. You could enter your second mortgage information here, enter all your balance, rate, term, age in months, everything. You'd see what your payment was. You'd hit save and close. But in this case, we're just going to assume we're just refinancing your first mortgage. Repeat deposits. This is a very important field. This is net. So this is what hits your checking account or savings account net every month. So after taxes, after deductions, after benefits, whatever, we're looking for the net amount that actually hits your checking account statement. So it would make sense for you to pull up your checking account statement or your savings to see what gets deposited in every month. We're going to say in this example, frequency of deposit does matter, okay? So we're going to say in this example that the borrower we're working with deposits $7,000 twice a month. So twice a month, $7,000 net hits the checking account. We're going to skip this part and go down here to the bottom here really quick and click on this repeat deposits. Now, this would assume either a second job, so you could put additional deposits in here, or like maybe you get a quarterly bonus, okay? You could enter those deposits in here as well, or maybe you have a co-borrower. In this case, we're going to assume a co-borrower. So we're going to assume $3,000 again twice a month, so net hits the checking account statement twice a month. We're going to assume that's the case, and we're going to select Save and Close. Now, if you scroll down, this will summarize that $20,000 net hits the checking account every month. Now, let's go back up to this one-time deposit. I'm going to try to cover this quickly because it's really cool. This is what makes the all-in-one awesome and a smarter, more innovative mortgage. With traditional financing, most people have a mortgage. So let's say your $775,000 balance, okay, over here costing you 5%, and you have your rainy day fund, okay, your savings account just in case, and it's over here earning you 0.5%, 1%, but you don't want to touch it, right? Because when you use it, you lose it, you don't have access to it, and so you keep that over there in your savings, not to be touched. Well, what an all-in-one does is it combines a mortgage and a checking and savings all into one, and what you do is you pay interest only on the net amount, right? Way smarter. Like, why don't all banks do this? They should. So let's take your $775,000 balance. Let's just say you've got $100,000 sitting in savings over there earning 0.5%. Now you take your 775 minus 100,000. Your net is 675. You're only paying interest on the 675. And here's the beauty of it. The all-in-one loan is a first position home equity line of credit. You have access to it for as long as you have this mortgage. You don't lose that access if you use it. You actually benefit, more flexibility. That's why the all-in-one loan is awesome. So we're going to say in this example that there is $100,000 sitting in a savings account, okay, that is earning you next to nothing. And we're going to apply that to our all-in-one mortgage. Now, if there are any future one-time deposits you knew you were going to get, you could enter that here. If you were going to sell something, whatever that may be, you could enter those one-time deposits there, but we're going to assume not and hit next. Now, this screen is also important. Taxes and insurance, the all-in-one loan simulator assumes 1.5%. I typically think that's a little high. We're going to drop that down to about $1,200. You would use your mortgage statement again to see what your property taxes and insurance are, or if you don't escrow them, then you could just pull up your property tax bill and your home insurance bill, see what those numbers are combined, plug that number in there. Now, this percentage left over, this is what is left over at the end of every month after you paid all your bills, all expenses, everything. What is left over at the end of the month? We're going to say in this example 10%. That means 10% of your monthly deposits, okay, what hits the checking account, 10% of that is left over at the end of the month. That's $2,000. That assumes that all your other expenses outside of your mortgage, okay, so car payment, student loan debt, credit cards, entertainment, food, gas, everything else totals up to $12,500. Now, you could itemize this, but I tell people not to do it because they typically underestimate what they spend on entertainment and food. So, but you could break it all down if you wanted to. I don't recommend it. I think you get a better, more accurate number by just knowing approximately what you have left over at the end of the month. We're going to say 10%. It could be 15%. You could have $3,000 left over at the end of the month, which would mean you are spending $11,500 in your expenses. Again, you have a pretty good idea of what you have left over at the end of the month. Use that number. And then if you had any future one-time expenses, like if you knew you were going to have a kid in college, or you're going to have to buy a car, or whatever it is, you could enter future one-time expenses and when you think that expense would hit. But we're going to assume not and click calculate results. We are almost done. All right. In this example, okay, doing an all-in-one to replace your existing mortgage. The all-in-one would be paid off in 200 payments. So this shows the payoff, 200 payments, 16.7 years. You would save close to $100,000 with the all-in-one. All right. Now, what I want us to do is I want us to click this rates and assumptions because this is really important. All right. Now, the simulator assumes a 4% margin. Now, what is a margin? A margin is a fixed amount that's going to be added to the 30-day average SOFR. That is the index, 30-day average SOFR, which will change on a monthly basis, but this margin will not change. Now, if you click this drop down, you're going to see multiple different options. Okay. Now, each one of these options has discount points associated with it. And as you go down in margin, you pay more discount points to get a lower margin. Okay. So we would have to compare and see which margin plus the cost of that margin, which one of those made the most sense for you. The sweet spot for most people is about 3.25%. Now let's just say, and then we're just using an example here, like 4% margin may have 0 discount points. 3.25% margin may have 1 discount point. Again, we would run the numbers to see which one made the most sense. We're going to go with 3.25. It's kind of that sweet spot. That means our initial rate, 3.25 plus the 30-day average SOFR is 4.319. Again, this is what it'll be for the life of the loan. This index, when it changes, which is once a month with the all-in-one, that means that the rate, your actual rate, the combination of these two is 7.569. Now, we're just going to hit return to results really quick, and we're going to see what that does, okay? We're going to hit yes, and now we went from a little under 100,000 to over 200,000. Okay, so now this thing's starting to make sense. Now this thing's starting to look sweet. Okay, you pay it off in 182 payments or 15.2 years, but we're not done. All right, let's click this rates and assumption one more time. All right, and we are going to look at this rate trend field. Now, this rate trend shows us that we're assuming with this calculation that this rate never changes, or it is the average of the rate for the life of the loan. Okay. And in my opinion, that's kind of a worst case scenario or a bad case scenario, I would just say, because we all know right now rates are higher than they traditionally are. So the likelihood is that rates will come down. So how do you kind of factor in that? Well, you have different assumptions for rate trends. You can actually go worst case, worst case, initial rate +1. Initial rate +2. You can see what these do to the cost savings. I'm going to go with this historical average rate because I like to see what it has been historically. And let's click return to results. Click yes, save. Boom. Now we're almost up to 400,000. Okay. Now we're making a real dent, and this thing is looking really sweet. Paying it off in 152 payments or 12.7 years. This shows you your total expense would be a little over $1 million for the AIO. Total expense for the conventional loan would be $1.4 million. That's where almost saving $400,000 comes from. So what this tells you is the most important thing is not necessarily interest rate, right? Because if we looked at this assumption, okay, this interest rate is 5.574. That's what the average rate for the all-in-one would be. If we go back, okay, and we just do a rate trend of remain at initial rate, an average rate of 7.569, okay, which is higher than the rate of 5%, you're still saving $200,000 compared to a traditional mortgage. And what's really cool about the all-in-one loan is when you pay it down, and as you pay it down, you'll see it, then you still have access to it. You have access to the remaining equity for 30 years, okay? Now, there are some formulas to show what happens after year 10, but we can get into more of those details. I would love to discuss that with you. I just want to hit a couple things. Pay down summary. I want to highlight this. The all-in-one loan, at this, okay, where we started, and we said the average rate was 7.569. But because of the way the all-in-one works, okay, and you save significantly on interest, that makes the effective APR in this loan 3.39, which is well below your average APR for traditional financing of 5%. Let's go back to return to results. You can also click this pay down table. You can see what it would be after 12 months, after 24 months, comparing it to the traditional loan. Remember, traditional loan, you pay more interest up front first. So the all-in-one loan destroys a traditional loan in the first few years. It's not even close. Return to results. All right, there's plenty of other things. Wealth accumulation, your financial advisor would love this. What are you going to do with the money after you have paid it off? Let's invest it at 5% return. This shows you that you'd make $1 million, just under $1 million. Okay, so you can see what your wealth accumulation forecast would be. Let's use default and close. If you wanted to save this, you could save it and share it. Man, share it with your family members, share it with your financial advisor. The more people that know about this thing, the better it is for me. If you want to change anything, you can go back to change your spending. Okay, you can change that to 15%. You want to change your deposits, go back and change those. Do not hit the back button. And then you can hit calculate results. So as you can see, the all-in-one loan, if it makes sense, it can be a dramatic savings. And my goal is to get you to change from what is the interest rate to what is the interest cost. How much is this loan costing me? And in this scenario, total expense, $1.2 million. Over here with traditional financing, $1.4 million. This is with a lower interest rate than this, but it's all about interest cost. I would love to talk more about this with you. If you have any questions, reach out, Todd Crane, 719-482-5359, or email me, todd.crane, todd.crane, at Valor, HLVALOR, HL.com. Thank you. Really excited. Looking forward to talking to you more about this.